All right, fellow AMC stockholders, XMAX Trading here. I'm going to go over some pretty amazing DD that came out about the how meme stock traders are impacting the market. So go ahead and subscribe to the channel if you haven't already. Hit the like button. Let's get started. Meme stock market crash cost speculators $48.9 billion. The meme stock rally, fun while it lasted, it may not be over forever. But it's handing out of an expensive lesson now. It's falling more than S&P 500 for now. A nearly month-long slide in stocks is mercilessly pounding AMC and GameStop and Peloton and DWAC. Those are among the hardest hit, says Investors Biz Daily analysis of data from S&P Global Market and MarketSmith. The analysts look over 25 popular stocks with meme traders, plus those most highly shorted compiled by Solactive for the upcoming selective Roundhill meme stock ETF. I think they're doing this ETF so they can short the ETF. Jeez. Some of the pain is brutal. These 25 stocks on average are down 25% in just a month. That adds up to $48.9 billion loss on them in 4 weeks. In comparison, the S&P 500 is under pressure too, but it's only down 2.7%. It's the first time many of these speculators playing these risky stocks, many with no fundamentals, have seen losses. Oh, they're trying to bash retail bastards. We have many investors who don't have the real depth and experience in the markets right now, and using the analogy of a casino, the worst thing that can happen to you is the first time you go, you win big. Oh, that's the worst thing that could happen, right? You win. Advisory TOs. Then you keep going back and get reckless. You're not as skilled as you believe, and the house eventually wins. Meme stocks have seen a very speculative move. Meme stock pain is reaching fans. A custom market-weighted cap index of 25 stocks topped out January 27th. Since then, it collapsed more than 24%. Much of the pain happened in just the last 4 weeks, with the index dropping more than 17%. Some of the individual stocks have done much more poorly. Peloton, the worst of them all, plunging 52% in a month. I never heard about Peloton being a stock market meme, to be honest. GameStop, the original meme stock, is down 21%, and blah, blah, blah. So DWAC. They're not saying anything about AMC. What's next for the AMC stock move? What's next for meme stocks versus S&P? Fans of meme stocks might point out that they are still up for the year. That's true, but they're lagging the S&P 500 now. Take their AMC surge, still huge up from the year. It's even up 40% from the meme peak, but in just 1 month, it's down more than 30%. That's much worse, but whatever. At this point, meme stocks are now lagging the market. Blah blah blah. This article is ridiculous. Trying to get you out of the meme stocks, trying to say, I mean, the meme stocks did so much better than the S&P back in this year, mid-year. They did way better. They don't want to talk about that. Robinhood is not a meme. They're the ones who are trying to screw us over. DraftKings, Beyond Meat. Yeah, Beyond Meat's interesting. Virgin Galactic. So here's the deal. It's the end of the year. Tax loss harvesting. COVID and all that stuff. So, the market goes down. End of year, then beginning of the year, it might go back up. Here's an interesting article. Short sellers, channels, and Quidar, that's an evil genius guy, evil sidekick, have been zooming with Congress in hopes of fending off regulation. This is back in March. 2 short sellers of managed fund hedge associates are pushing back against possible disclosure shorts. 2 private short sellers, Kinecos Associates Jim Chanos and Fahmy Quidar of Safakis Capital, have recently been holding Zoom meetings with members of Congress and staff in hopes of warding off future regulation on short selling. The meetings with Chanos and Quidar are arranged by the Managed Funds Association. Sounds devious. People are thinking seriously about this idea of disclosure of short positions, which many hedge funds oppose. Geez, wonder why. Such a change wouldn't affect the small group of dedicated short sellers, whose numbers have diminished in recent years. It would also force long short equity hedge funds with almost $1.1 trillion in assets under management to make short positions public. Hedge funds must now disclose their long stock holdings, as well as many short positions that are made via listed put options, and quarterly filings with the SEC exchange. While European regulators also force funds to disclose some of their short positions, that has not happened in the U.S. So they have to disclose the put options, the put contracts, but not shorting of the actual shares. The notion that such disclosure came up briefly last month in the GameStop hearing, if they should disclose more short position. Plotkin sidestepped the question, saying, "It's not for me to decide, but if those are the rules, I'd certainly abide by them." Notably, Melvin has become the target of retail after it disclosed listed put options on GameStop. According to Kadar, she and Channel has been talking to Democrat and Republican members. The 30-minute Zoom call was being organized by the MFA, Managed Funds Association, dun, 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 a hedge fund lobbying group. MFA staff members have been on the calls. Kadar, who said MFA contacted her about being involved in the effort, estimated that at least 10 meetings have been held with various stakeholders, which also includes people from the SEC. These meetings have been going on for about a month. Eventually, she said the short sellers will start talking to senators and their staff as well. Yeah, directly pressuring them. The more we can drive on what we do, the less likely they are to taking extreme measures when things change in the market. The worry is that short sellers will be blamed for a market crash, as happened in 2008. But Kadar said the only pushback against shorts so far has been the disclosure of their positions. Salafi Capital, she explained in the means the companies will retaliate against short sellers if companies know their positions, detailing how she's been shoved to such attacks. Even for Kadar, when public with her criticisms of shorting, with her criticisms of shorting Wirecard, the German financial firm that collapsed last summer in a scandal, the company hired private surveillance firms to follow her and was trying to hack her emails. That's not right. I mean, regular short sellers are good. The synthetic shorters are the bad. Kadar said she believes Wirecard knew she was short because her name appeared publicly in an FOA database about the company. If they'd seen public short positions, they wouldn't even have to jump through all the hoops and hurdles of hiring investigators, and they'd figure out what I'm doing. I'll just be handed over in the silver platter. President, he said the purported benefits of hedge funds disclosing their positions is unproven at best. MFA has long held the position that public disclosure of individual positions is neither beneficial to investors nor market integrity. Fundamental short research exposes frauds as Enron, Valiant, Wirecard, and issue retaliation against short sellers one of the most significant reasons why disclosure is harmful and unnecessary. Clear and negative impacts on market equity, price discovery, and inefficient capital formation demonstrate harm far beyond retaliation. While the hedge fund industry successfully sent off similar proposals for public disclosure of shorts following 2008, not everyone is on board this time. One dedicated short seller told institutional investor that he would welcome such disclosure, arguing that most of the opposition comes from long and short equity hedge funds. One reason is that these firms don't want to disclose a short position is, he said, is the impact it would have on their access to corporate managements. Long short equity hedge funds have accounted for more than 30% of total hedge fund industry assets, about $3.6 trillion, so about 30%, making them the biggest single strategy according to hedge fund researcher. Channels declined to comment. Now listen to this. AMC Entertainment Drama is exposing risking $11 trillion worth of indexing. This is back in June. Index funds are supposed to cut out the human-driven craziness that periodically affects the market, but the meme stock fever proved the $11 trillion industry is far from immune. The remarkable surge of AMC shares and a handful of other stocks are showing up in multiple exchange-traded funds, skewing portfolios, altering risk profiles, and exerting outsized influence on prices. Take 68 billion Russell's 2000 ETF, IWM. In the past week, Thursday, AMC powered 70% of the prox advance. The stock was responsible for, paywall. Oh, son of a gun. But anyway. Oh my god. It's craziness, guys. So just remember, tax loss harvesting, and it's for the end of the year. The Omicron event is here, but it may go away in 2 months. Maybe negated, better vaccines, negate the impact, and then, AMC is going to pay off their debts. Not financial advice, but they could be paying off their debts next year. Maybe have more NFTs, more blockbusters, more popcorn, merchandise, whatever. So I would not want to be short AMC, not financial advice. So, all right, guys, until later, next time.